Imagine a time before credit cards, online banking, or even a stable national currency. It might sound strange now, but this was the reality for Americans in the late 19th and early 20th centuries. Back then, the financial system resembled the Wild West with few rules and a lot of volatility. Hundreds of different banks issued their own banknotes, leading to a confusing patchwork of currencies. Economic booms and busts were commonplace, often triggered by speculation or bank runs. The lack of a central authority to regulate the money supply or provide emergency loans left the economy vulnerable to panics and depressions. This chaotic environment made it difficult for businesses to thrive and for ordinary people to manage their finances. Something had to change. America needed a more stable and reliable financial system to support its growing economy and increasingly interconnected society. The financial landscape was a maze of uncertainty. Imagine walking into a bank and not knowing if the banknotes you received would be accepted elsewhere. This was a daily reality for many Americans. The lack of a unified currency meant that people had to navigate a complex web of different banknotes, each with its own value and level of trustworthiness. This patchwork system made everyday transactions cumbersome and risky. People had to be constantly vigilant, ensuring that the money they received was legitimate and would be accepted by others. This uncertainty extended to businesses as well. Merchants and traders faced the constant challenge of dealing with multiple currencies, each with its own fluctuating value. The Industrial Revolution was in full swing, and America was rapidly transforming into an economic powerhouse. Factories were springing up, and new technologies were revolutionizing industries. However, the unstable financial system was a significant hurdle. Businesses needed a reliable way to conduct transactions, secure loans, and manage their finances. The lack of a central authority meant that banks operated independently, often with little oversight. For ordinary people, managing personal finances was equally challenging. Saving money was risky, as bank failures were common. People had to be cautious about where they kept their savings, knowing that a bank run could wipe out their hard-earned money overnight. The absence of a central bank meant there was no safety net, no guarantee that their savings would be protected. The need for a more stable and reliable financial system became increasingly apparent. The growing economy and interconnected society required a financial system that could support its needs. The establishment of a central bank, the Federal Reserve, in 1913 was a crucial step towards creating a more stable and reliable financial system. It provided a central authority to regulate the money supply, offer emergency loans, and ensure the stability of the financial system. The creation of the Federal Reserve marked the end of the Wild West era of American finance. It brought much-needed stability and reliability to the financial system, allowing businesses to thrive and people to manage their finances with greater confidence. The Wild West of American finance was tamed, paving the way for the modern financial system we know today. The need for a central banking system became glaringly apparent during the Panic of 1907. A failed attempt to corner the copper market triggered a chain reaction of bank failures and a stock market crash. Lines of anxious depositors snaked around city blocks, desperate to withdraw their savings before their banks went under. The crisis exposed the fragility of the American financial system. While some prominent financiers managed to pool their resources and stem the tide of panic, the experience left a lasting impression. It became clear that a more permanent solution was needed to prevent future crises and ensure the stability of the nation's economy. In the aftermath of the 1907 panic, a group of influential figures began to advocate for the creation of a central bank. Among them were Senator Nelson Aldrich, a powerful Republican from Rhode Island, and Paul Warburg, a German-born banker who had witnessed the stability provided by central banks in Europe. Their vision was to establish an institution that could regulate the money supply, provide emergency loans to banks, and oversee the financial system as a whole. This central bank would act as a lender of last resort, preventing bank runs and stabilizing the economy during times of crisis. After years of debate and negotiation, the Federal Reserve Act was finally passed by Congress and signed into law by President Woodrow Wilson on December 23, 1913. This landmark legislation created the Federal Reserve System, often referred to as the Fed. The Fed was designed as a decentralized system, with 12 regional banks located across the country. This structure was intended to ensure that the needs of different regions and industries were represented. A central governing body, the Federal Reserve Board, was established in Washington, D.C. to oversee the system and set monetary policy. Section 5. A new era for American money. The creation of the Federal Reserve marked a turning point in American financial history. One of its most immediate impacts was the introduction of a new national currency, the Federal Reserve Note. These notes replaced the hodgepodge of banknotes previously issued by individual banks, creating a single unified currency for the entire nation. The Fed also began to regulate the money supply by setting reserve requirements for banks and by buying and selling government securities. These actions influenced interest rates and the availability of credit, giving the Fed powerful tools to manage economic growth and inflation. Section 6. Weathering the storms. The Fed's ability to stabilize the economy was put to the test during World War I. To finance the war effort, the government borrowed heavily, putting a strain on the financial system. The Fed responded by providing loans to banks and ensuring the smooth functioning of financial markets, helping to prevent a major economic disruption. In the years following the war, the Fed continued to play a vital role in managing the economy. It helped to moderate the boom and bust cycles that had plagued the nation in the past, contributing to a period of relative economic stability. Section 7. The Great Depression and the Fed's response. The Great Depression of the 1930s presented the Fed with its greatest challenge yet. The stock market crash of 1929 triggered a wave of bank failures and a sharp contraction in the money supply. While the Fed took some steps to ease the crisis, it has been criticized for not doing enough to prevent the depression's severity. Some economists argue that the Fed's reluctance to inject more liquidity into the banking system exacerbated the downturn. Others contend that the Fed's powers were limited at the time and that the depression was caused by a complex interplay of factors. Section 8. The Fed's evolving role, from gold standard to quantitative easing. In the decades following the Great Depression, the Federal Reserve's role in the economy continued to evolve significantly. The economic turmoil of the 1930s had shown the need for a more active central bank, one that could respond to financial crises and help stabilize the economy. A pivotal moment came in the 1970s when President Richard Nixon announced the abandonment of the gold standard. This monumental decision gave the Federal Reserve greater flexibility in managing the money supply, allowing it to respond more dynamically to economic conditions. The subsequent decades saw the rise of globalization and rapid technological advancements in finance. These changes presented both new challenges and opportunities for the central bank. The Fed had to navigate an increasingly interconnected global economy, where financial markets were more complex and volatile than ever before. The 2008 financial crisis was a defining moment for the Federal Reserve. The crisis, which began with the collapse of major financial institutions, required the Fed to deploy an evolving toolkit of monetary policies to stabilize the economy. One of the most significant measures was the implementation of unconventional policies like quantitative easing. This involved the Fed injecting trillions of dollars into the economy by purchasing assets such as mortgage-backed securities and government bonds. The goal was to lower interest rates and increase the money supply to stimulate economic activity. These actions were instrumental in preventing a complete financial meltdown. However, they also sparked intense debate among economists and policymakers about the long-term consequences of such extraordinary measures. While some argued that quantitative easing was necessary to avert a deeper recession, others warned of potential risks, including inflation and asset bubbles. Today, the Federal Reserve continues to play a crucial role in shaping the U.S. economy. Its policies and decisions are closely watched by markets and governments around the world. As the economy evolves, so too does the Fed's approach to ensuring financial stability and promoting sustainable growth. Section 9. The Legacy of 1913. The creation of the Federal Reserve in 1913 was a watershed moment in American economic history. Before its establishment, the United States faced frequent financial panics and bank runs, which destabilized the economy and caused widespread hardship. The Federal Reserve was designed to provide a safer, more flexible, and more stable monetary and financial system. It marked the end of the Wild West era of finance and ushered in a new era of central banking. This transition was crucial in bringing order to the chaotic financial landscape of the time. The Federal Reserve introduced measures to control the money supply and interest rates, which helped to stabilize the economy and prevent the kind of speculative excesses that had led to previous crises. The Fed has played a pivotal role in shaping the U.S. economy over the past century, from managing inflation and unemployment to responding to financial crises. Its ability to influence economic conditions through monetary policy has made it a central player in the nation's economic health. During times of economic downturn, the Fed has acted to inject liquidity into the financial system, helping to avert deeper recessions. While the Fed has faced its share of criticism and controversy over the years, its importance remains undeniable. Critics argue that its policies can sometimes exacerbate economic inequalities or lead to unintended consequences. However, its defenders point to its role in maintaining economic stability and preventing financial disasters. As the steward of the U.S. dollar and the overseer of the financial system, the Federal Reserve continues to wield immense power and influence. Its decisions on interest rates and monetary policy are closely watched by markets around the world, and its actions can have far-reaching effects on global economic conditions. Its actions shaping the economic well-being of the nation and the world. The Fed's influence extends beyond the borders of the United States, affecting international trade, investment, and economic policies. As we look to the future, the legacy of the Federal Reserve's creation in 1913 continues to be felt, reminding us of the enduring impact of this pivotal institution on the global economy.